In this video, we're going to learn about why dividend stocks might not be the best option all the time. Investors love dividend stocks. Let's not dance around the point. They think dividend stocks are just, you can't do wrong. But actually, let's take the other side of this debate. Dividend stocks, first of all, there's a double taxation issue going on. The company gets taxed from their profits, and then they give out the cash to you, and you get taxed on those dividends. That's double taxation. On the other hand, if the company had just bought back shares, then the earnings per share would have increased, and the stock likely would have increased from there. So you're sitting on some capital gains. Of course, if you actually sell the stock, then you're hit with that taxation. But the thing is, long-term capital gains taxes are lower than dividend taxes. So that's just something to think about right there. Secondly, dividends, for the sake of dividends, I'm not convinced is the best thing. So think about this. ExxonMobil has been paying a dividend and actually increasing their dividend for more than 25 years, labeling them a dividend aristocrat. There's these groups of highly mature, stable companies called dividend aristocrats who have increased their dividend every year for 25 years or more. And so investors flock to these companies because they have rich dividend yields of 4, maybe even 5%. And as soon as the companies cut their dividends, all these investors flee because they're used to this income. However, ExxonMobil's business has been deteriorating for years now. They actually have even borrowed money to pay their investors the dividend. In my opinion, this is not a healthy business, and if you're paying out 80% or more, even 90% of the profits, even borrowing money to pay the dividend, I'm not convinced that in the long term this is a healthy business to be invested in. Just because you see that fat dividend yield doesn't mean it is the best stock. Investors are actually just viewing these more as bonds, really. Since interest rates have been so low for so long, investors are chasing yield and they're finding it in dividend stocks. However, if interest rates increase, the cost of debt for these companies increases, and all of a sudden these companies aren't able to pay their dividends, sending investors fleeing. So in my opinion, in this rising interest rate environment, these stocks are actually maybe not the safest. So we have to think through these things rather than say, dividends are good because, well, AT&T, ExxonMobil, all these companies, they are companies that have been around forever, therefore they cannot fail. I think the logic there is too simple, and I think investors would do well to actually think these things through. Actually look at the payout ratios of these companies and see if they can manage their debt load in a rising interest rate environment. I welcome the other side of this debate because I know a lot of dividend investors are very passionate about this, and I by no means claim authority on this exact topic because dividend investing is not exactly my forte, but I think it's a good thing to think about. Appreciate it. Hey there, really appreciate you joining us at Investing City. We have all sorts of resources for you to learn as much as you possibly can about the stock market. From going over how to analyze a stock, to actually analyzing a stock, to personal finance issues. And so we really just are so happy that you're here with us, and we hope you get a ton out of it. Have a good one.